Today we need to talk about something important, something potentially terrifying. The American banking system, the very foundation of our economy, is looking about as stable as a Jenga tower built by a caffeinated squirrel. You might be thinking, you beautiful, bespectacled Brit, you're being dramatic again. But am I? We've seen this story before, haven't we? 2008 taught us a harsh lesson about the fragility of financial institutions. And guess what? The sequel might be even scarier. Here's the deal. A perfect storm of economic woes is brewing, and the eye of that storm is pointed directly at your bank. We're talking commercial real estate crashes, skyrocketing interest rates, and inflation so high it could make a roller coaster throw up. This isn't just theoretical, folks. This is happening right now. We're about to dive headfirst into the murky depths of the 2025 banking crisis, which, let's be honest, might actually be the 2024 banking crisis, but who's counting? Now let's break this down. The commercial real estate market is teetering on the edge. Office spaces are empty, retail stores are closing, and the value of these properties is plummeting. This isn't just bad news for landlords, it's a ticking time bomb for banks that hold these mortgages. And then there's the issue of interest rates. The Federal Reserve has been hiking rates to combat inflation, but this is a double-edged sword. Higher rates mean higher borrowing costs, which can stifle economic growth and lead to more defaults on loans. And speaking of inflation, it's not just a number on a chart, it's the rising cost of groceries, gas, and everything in between. It's the reason your paycheck doesn't stretch as far as it used to. And it's putting immense pressure on both consumers and businesses. So what can you do? First, stay informed. Knowledge is power, and understanding the risks can help you make better financial decisions. Second, consider diversifying your assets. Don't put all your eggs in one basket, especially if that basket is a shaky bank. And finally, don't panic, but do prepare. Have a plan in place for worst-case scenarios. Whether it's having some cash on hand, investing in safer assets, or simply staying vigilant, being prepared can make all the difference. The goal isn't to scare you, but to prepare you. The American banking system may be on shaky ground, but with the right knowledge and preparation, you can navigate these turbulent times. Stay tuned, stay informed, and stay safe. Together, we can weather this storm. Now, what do you know about finance? Fair point. But here's the thing. Even the big dogs, the Warren Buffetts and Jamie Dimons of the world, are starting to sweat. And when billionaires sweat, it's time to break out the industrial-strength deodorant because things are about to get stinky. These financial titans are warning of a financial hurricane headed our way. They're whispering about a credit crunch that could make 2008 look like a walk in the park. And they're doing what any smart billionaire would do, hoarding cash and bracing for impact. But let's break it down a bit. Why are these financial giants so worried? Well, it's not just about the numbers on a screen. It's about the underlying issues that could trigger a domino effect. Think about it. Rising interest rates, geopolitical tensions, and a global supply chain that's still reeling from the pandemic. All these factors are creating a perfect storm. And when you have a storm brewing, even the most seasoned sailors start to get nervous. So, when billionaires start sweating, it's not just a personal hygiene issue. It's a signal that the economic seas are getting rough. These financial titans are warning of a financial hurricane headed our way. They're whispering about a credit crunch that could make 2008 look like a walk in the park. And they're doing what any smart billionaire would do, hoarding cash and bracing for impact. And they're doing what any smart billionaire would do, hoarding cash and bracing for impact. Look, I'm not saying you should start building a bunker in your backyard and stockpiling canned goods, although, if you have the space. But it's time to pay attention, folks. When the people who built their fortunes on understanding the market start sounding the alarm, it's not the time to ignore them. It's time to listen. And not just listen, but to understand the signals they're sending. It's about being prepared, staying informed, and making smart decisions. So what can you do? Start by educating yourself about the current financial landscape. Follow credible sources, understand the basics of economic indicators, and keep an eye on market trends. It's not about panicking, it's about being proactive. And while the big players have their strategies, you can have yours too. Diversify your investments, keep some liquidity, and don't put all your eggs in one basket. It's about being smart with your money and staying ahead of the curve. When the people who built their fortunes on understanding the market start sounding the alarm, it's not the time to ignore them. It's time to listen. And not just listen, but to understand the signals they're sending. It's about being prepared, staying informed, and making smart decisions. Remember that whole work from home thing? Turns out it wasn't so great for office buildings. Commercial real estate, those shiny skyscrapers and sprawling office parks are looking emptier than a clown college after graduation. And empty buildings mean unpaid loans, lots and lots of unpaid loans. See, banks love lending money for real estate. It's like a giant game of Monopoly, except the banks are the ones buying Boardwalk and Park Place. But when those properties start losing value faster than a Kardashian marriage, banks get nervous. And when banks get nervous, they start doing things like calling in loans and tightening lending standards. This creates a vicious cycle. Fewer loans mean less economic activity, which means more businesses fail, which means more unpaid loans, and so on. It's enough to make you want to buy a one-way ticket to a remote island with no Wi-Fi and a lifetime supply of margaritas. Remember when you could get a mortgage for less than the price of a cup of coffee? The Federal Reserve, in its infinite wisdom, has been raising interest rates like a kid playing whack-a-mole at an arcade. And while that might sound boring, it's actually a big deal. Higher interest rates mean higher borrowing costs for everyone, from businesses trying to get loans to regular folks trying to buy a house or a car. And when people can't afford to borrow money, the economy slows down. It's like putting the brakes on a speeding train. Things are going to get bumpy. But here's the kicker: higher interest rates also hurt banks. See, banks make money by lending money, and when interest rates are high, people borrow less. It's a double whammy that's squeezing banks from both sides. Inflation Nation, your savings are losing value every day. Remember when a gallon of gas cost less than a gourmet latte? Those were the good old days. Now, thanks to inflation, everything is more expensive, from groceries to gas to that avocado toast you love so much. Inflation is like a sneaky thief, slowly but surely stealing the value of your hard-earned money. And while the government might tell you inflation is transitory, let's be real, it's about as transitory as a Kardashian marriage. What does this mean for your savings account? Well, if your money isn't growing at least as fast as inflation, it's actually losing value. That's right, folks, you're basically paying the bank to hold on to your money while it slowly disintegrates like a soggy tissue. FDIC insurance, not the safety net you think it is. My money is safe in the bank. It's FDIC insured. And you're right, to a point. The FDIC does provide a certain level of protection for your deposits, but there's a catch. A big, hairy catch. First of all, the FDIC only insures up to $250,000 per depositor per insured bank. So if you have more than that stashed away, lucky you, the rest is basically up for grabs. Second, and this is the scary part, the FDIC doesn't actually have enough money to cover all insured deposits in the event of a major banking crisis. We're talking trillions of dollars short. So while the FDIC might be able to handle a few small bank failures, if the whole system starts to crumble, it's going to be like trying to put out a forest fire with a garden hose. How to protect yourself. Cash is king, but don't forget these options. Okay, so we've covered the bad news. Now let's talk about what you can do to protect yourself. First and foremost, diversify. Diversification is key to mitigating risk. By spreading your investments across different asset classes, you reduce the impact of a poor performance in any single area. Think of it as not putting all your eggs in one basket. Don't put all your eggs in one basket, especially if that basket is a bank that's looking a little wobbly. Banks can fail, and when they do, it can be catastrophic for those who have all their savings tied up in them. One option is to withdraw a portion of your savings in cash. Having cash on hand can be a lifesaver in emergencies when electronic payment systems might be down. Carrying around stacks of bills like a drug lord might seem a little extreme, but having some cash readily available can provide peace of mind and immediate liquidity. But hear me out. In a true financial meltdown, cash is king. It's tangible. It's accepted everywhere, for now at least, and it can't be hacked. In times of crisis, cash can be the most reliable form of currency. It's tangible, it's accepted everywhere, for now at least, and it can't be hacked. Plus, having cash means you can make purchases even if digital systems are down. But don't go full-on doomsday prepper just yet. While it's good to be prepared, it's also important to stay balanced and not let fear drive your financial decisions. There are other less drastic steps you can take. For instance, regularly reviewing your financial plan with a trusted advisor can help you stay on track and make informed decisions. Consider investing in tangible assets like gold or silver, which tend to hold their value during times of economic uncertainty. These precious metals have been trusted stores of value for centuries. You could also explore alternative investments like cryptocurrencies, which have gained popularity in recent years. Cryptocurrencies offer a decentralized form of currency that can be an interesting addition to your portfolio. But be warned, those are about as predictable as a toddler on a sugar rush. The cryptocurrency market is highly volatile, and prices can swing wildly in a short period. So if you decide to invest in crypto, do so with caution and only with money you can afford to lose. Don't wait until it's too late. Act now to secure your financial future. I'm not trying to be all doom and gloom here, but the reality is the writing is on the wall, and it's written in big, bold letters that spell Financial Crisis 2.0. The good news is you still have time to prepare. This isn't about panicking, it's about being proactive. It's about taking control of your financial future and not relying on a system that's looking increasingly shaky. So what are you waiting for? Go forth and diversify, withdraw some cash, buy some gold, heck, buy a goat for all I care. Just do something, anything to protect yourself and your loved ones from the financial storm that's brewing. Because when the levee breaks, and it will break, you don't want to be the one left high and dry.